As major U.S. stock benchmarks run up toward record highs, is it time to get in or have you missed the rally? Here to weigh in are Edward Painman, Chief Investment Officer of Chase Investment Counsel, Jason Raznick, angel investor and founder of financial news website Benzinga.com, and Chris Versace, founder and editor of Power Trend Profits newsletter and host of Power Talk. Gentlemen, welcome to the program.
Thanks for having us.
Thank you, Jennifer. Good to be here.
Edward, let me start with you. We've had a quick run-up in such a short time. Do you think the market has gotten too far ahead of itself here?
It's a very good question, Jennifer. And in fact, we kind of adopt a longer-term view here. And if history is any guide, with January being up, typically 80% of the time the rest of the year is up, on average about 12%. So the fact that we're up about 6% already year to date sounds like we're about halfway there. So it's not going to be a straight line up. I bet you there's going to be some areas of consolidation here and there, and maybe a minor pullback. But if you adopt a longer-term view, I think it's going to be a good year.
Jason, if I look at the market's behavior trajectory this year, it reminds me a lot of the beginning of last year. The market started off 2012 on a high note, and the 10-year Treasury yield popped up to 2%, just like it has now. But the moves proved short-lived. Do you see the same path for this year?
I actually see the overall market improving and keep continuing to improve versus the past couple of years you had to pick individual stocks. I think this year you could throw some darts and really see some bounces. I'm seeing a lot of trends with employment picking up, going out to the bar and hearing people talk about stocks. That's usually a contrary indicator, but it seems people are just getting in and getting back interested in the market. I think there's a lot of reasons for that, and we could talk further about that, but I see the overall trend versus last year. I see the market really ramping up throughout the year.
Chris, what's your outlook for the market? If you haven't invested in stocks, do you wait for a pullback or do you get in now?
Well, based on where we are, as the guys ahead of me already said, January's been a very strong month. But as we start to look forward, we're seeing gas prices start to rise. We're seeing food prices start to climb. We also have to deal with the payroll tax holiday, higher health care costs. So when you put all that together, I'm a little concerned about the consumer. Also, too, over the last 2 years, we've had some serious bouts with uncertainty about the debt ceiling, the fiscal crisis, and we're going to start to see that all again as we march even closer to March 1st.
So, Chris, do you think that the risks are priced in at this point, or do you think we're due for a little pullback here in the short term?
I think we're, much like Jason and Edward, I do think that overall 2013 is going to be a good year. Having said that, though, I wouldn't be surprised if we see a little bit of a pullback. Not a correction, nothing like 10%. But I do think something to take some of the froth out of the market given such a strong January.
Let's drill down a little bit on those fundamentals. Edward, I know you said that you think longer term we are headed higher. In short term we could have a little bit of a consolidation, but I sort of wonder whether markets are getting too far ahead of economies, right? You look at the U.S., growth is still anemic. You look at Europe, it's in a contraction. It's like there's no relationship between the stock market and the economy.
Yeah, it needs to be linked. And if you're thinking about the global economy, and I guess here domestically, I guess we're targeting 2 to 3% GDP growth. You're not going to get stock price appreciation significantly higher than that. And already we've got about a 14 multiple over the next 12 months on the S&P 500. So to make an argument that you can get multiple expansion from here is a little bit of a stretch, particularly with the 10-year yield starting to creep up a little bit. So I think from here you're going to get market appreciation kind of in line with earnings, and the earnings, at least for this year, are sort of being modeled close to 5-6% year-over-year growth. So I think that's going to be sort of a barrier, if you will, for how much we can really get stocks going up this year.
Yeah, I want to come back to earnings in a moment. Jason, you run Benzinga.com and you're an angel investor. What are you seeing now as far as the U.S. economy is concerned?
Yeah, I mean, we're seeing a lot more people, a lot more applications getting into the stock market. So we're seeing a lot more students from schools sending resumes in, which means there's a pickup in the stock market where people are bullish and like, hey, America's back. I want to get back into invest in American companies. In regards to the economy and being an angel investor, we're seeing a lot more excitement, but real companies now that actually make money versus these pie in the sky. I'm going to make an app that's going to, tell me when I get home or cut my ride home faster. So we're seeing people focus on fundamentals a lot more in the economy, and also it's just a constant. It's harder to find people too. So I think you're going to see unemployment rates improve. And, you know, there's going to be those one-time blips where that statement will be wrong, but you're going to continue to see this upward trend of people going to work, getting back in the workforce, and new startups that really solve problems and make money keep happening. I mean, that's what we're investing in.
So would you expect growth to pick up this year after GDP stalled in the fourth quarter?
Yeah, see, I do. I may be Pollyanna. I may be Pollyannish. I mean, I think you're going to see a decent pickup. I guess that's what I'm seeing on the front lines here. I mean, I'm seeing it with our business. I mean, customers calling us to buy data and all this stuff from us. I'm seeing it every day. And the only reason they do that is because people are buying stuff from them and they need more stuff from vendors like us. So we may be a myopic analogy, but you know, Costco on the weekends, I haven't seen it more crowded. Maybe that's a trade down to, you know, low price goods, but I mean, we barely can fit into our local Costco. It just seems different than it did in 2011 and 2012, and that's just from my perspective in Michigan.
All right, Chris, well, part of the reason growth stalled in the fourth quarter was because government spending fell on account of a 22% drop in defense spending. Of course, we've got that pending sequester ahead of us right on March 1st. We don't know how these budget battles are going to play out. Chris, do you think that businesses and consumers can pick up the baton here and make up for any forthcoming shortfall in government spending? Well,
to me, it's a real question of uncertainty yet again. And I think when we look back over the last 2 years, you know, again, we had the original debt ceiling conversation where we almost shut down the government. We had the fiscal cliff. And if we look at the data from the months ahead of that, of those two times rather, we've seen things start to slow down a little bit. And as far as the consumer goes, yes, there's the argument that they're a significant piece of the domestic economy. But again, you know, rising gas prices, rising food prices, and several other items seem to suggest that the consumers, you know, I won't say totally tapped out, but disposable income is going to be very, very tight.
All right.
But Chris, this is Edward. Keep in mind also we are getting a positive wealth effect from the U.S. housing recovery. Right?
No doubt about that. I think you're absolutely right. But you have to remember, though, there are how many millions of people still underwater in their mortgages who are still borrowing against their house. Mm-hmm. So I think it'll help. And I think that helps paint the overall picture for 2.5% GDP growth this year. But I think as we look for March and what that might mean for the second quarter, you know, I do think there's some risk involved.
Well, that's a perfect segue to the Fed's policies. I mean, Edward, how do you feel about the Fed's policies here? There have been some concerns that the Fed's policies are actually holding back the economy. What's your sense?
My sense is that we're not operating in a free market society as it relates to treasuries. I mean, we have a Federal Reserve with a $3 trillion balance sheet, adding $85 billion a month, so it's going to be close to $4 trillion by the end of this year. And they're truly an artificial buyer as it relates to MBSs as well as treasuries. And you know, it's definitely painful for the savers out there because they're not getting an accurate rate on their return on their investment. And I think really that the canary in the coal mine is going to be what's going to happen to yields once we get a curtailment or a termination of this QE program.
Well, but how do you think? Oh, go ahead, Chris.
I'd say, Edward, you know, your point about low interest rates, I agree wholeheartedly. Don't you think after several years, if not quarters, that's actually pushing people finally into the market after such a big move? You know, we saw strong January inflows, and we heard Jason talking about his business where he's seeing a lot of applications and things like that.
Yeah, we're definitely seeing flows. We're also seeing record low yields on the junk bond market. The one thing that we also take a look at is the sentiment readings. And one thing we didn't talk about is the NYSE margin debt, which right now, the last reading we got was for December of last year, and it peaked over $320 billion. And I hate to say it, but the last time we were at levels this high was the credit crisis of 2007. So there is definitely a lot of retail borrowing occurring to participate in this marketplace, and that on the margin does worry me.
But let's step aside a minute from the wealth effect. I understand the whole idea that Bernanke is trying to get the market to go up and then get consumers to spend and so on and so forth. But do you think that this ZIRP policy is hurting banks, and therefore, although rates are at zero and that's an incentive for borrowers to borrow, is it really an incentive for lenders to lend, right? We know that credit is the oxygen for an economy. Edward, then Chris.
I think that, yeah, on the margin, if people know that interest rates are going to stay down this low, there is not an incentive to go out and borrow necessarily today if they know that they have 6 months to do so. That being said, I still think it's a penalty for savers. And the biggest risk, I think, is if we get a continued backing up in the yields, I mean, the convexity on these bond portfolios is going to be enormous, meaning that, the average 30-year bond last month was down about 6% in an actual return. So you've wiped out pretty much all of your interest payments for the whole year, if not more, in one single month. And a lot of people, I think, have been talking about this, and it's going to be something that the Fed needs to keep in mind as it tries to navigate its way through this program.
Chris, go ahead. You were going to make a point.
Well, I was going to say that we're seeing mortgage rates tick up a little bit, and I actually think that's a good thing. Once people start to see mortgages rates ticking up, the people who are sitting on the fence, those indecisive buyers that Edward was kind of alluding to, they actually might get off the fence and into the marketplace, and that could be a good thing, particularly for the housing economy.
Okay, let's talk about earnings, right? We're at a point where it seems that companies have squeezed out as many costs as possible while sales growth remains weak. Now I'm hearing that companies are looking to buy up their own shares to boost earnings per share. Edward, you alluded to this earlier. You expect 5 to 6% earnings growth, but that could be a barrier for the market. What do you think about companies growing earnings per share through buybacks versus through sales growth organically?
Yeah, no, that's a key driver. I mean, if you're a management team of these Fortune 500 companies and you're operating in a low growth environment like we are today of 2-3%, and you've also realized that you've peaked out your operating margins at 10%, which are at kind of historic record levels, how else can you engineer high single-digit, earnings per share growth rate? And the best way to do it is through share buybacks. Chris talked about the fact that we've got compensation costs that are going to start to pick up soon, healthcare costs which are picking up, and so these management teams are going to have to come up with tricks to fabricate this share growth rate for these earnings, and this is going to be one way they're going to do it.
Jason, as long as profits are moving higher, does it matter what the quality of the earnings is? Will the market move up on that?
Yeah, the market can still move up on that. I mean, it really comes down to deployment. So 3 years ago, companies wanted to grow by sales. Then last year before, cut costs, trim everything you can. And now we're at the stage where you inched out every sale you can get. You offered Groupons, you cut costs. So some companies, innovation is always going to happen, but the quickest thing is, hey, we need to spike up earnings. Let's get rid of some shares. The economy can still improve on that. You're going to see increase in sales. You just do. But once you minimize the cost, your sales increase. You got to, it's deployment of capital. Where is the best way to deploy capital? So at a startup like our company, the best way for us to deploy capital is growth and hiring people. It's not necessarily buying back shares or, cutting costs. In a company like a General Electric, they have a lot of cash on the balance sheet. Now, if they find a new energy opportunity, they'll deploy the cash there. But for each company, it's about capital deployment versus, it depends on the sector. Macy's just had great retail comps, so they may deploy more cash to expand versus cut costs there. Maybe they figured out something that Nordstrom didn't. So it's dependent really on the sectors as well, not just an overall economic theory.
Chris, you brought up a good point in the pre-interview. You said if the market doesn't pull back, then companies might not purchase their own shares. What does that mean in next buybacks? What are your expectations for earnings growth?
Well, I think what I said before is absolutely right. It's that as the stock market has soared in January, the number of firms that initiated buybacks in 2012, 2011, or even some that might have announced them in January alone, are going to be less interested in buying their stock back at elevated levels. So I think it's really going to be a challenge for some of them to execute on that. At the same time, to Jason's point, it's about allocating and utilizing capital. What we've seen a number of companies do of late too, particularly in November, December, ahead of what we thought was going to be the fiscal cliff, was increasing their dividends. And I think that's a great way to return capital to shareholders. It also helps people who are analyzing stocks look at these higher dividend payouts and say, maybe the floor on the stock's a little higher.
All right, well, let's talk about about where you're all investing right now. Edward, last we spoke, you said you liked Precision Cast Parts, ticker PCP. And for those in the audience who don't know, the company makes replacement parts for airplanes. And you said one of the reasons you liked this play was because Boeing's production schedule for its 787 Dreamliner is expected to double over the next 12 to 18 months. How do the complications with Boeing's 787, that lithium-ion battery, factor into your overall outlook for PCP, if at all?
Yeah, it's something that we're monitoring, and we've been listening to management from Boeing. And fortunately, this is a very isolated incident in terms of where the issue is coming from, which is the battery, which PCP is obviously not implicated in that. And Boeing did a very good job of giving us confidence that their production schedule for the 787 is not going to be compromised. We're at about 5 planes per month. It's still being targeted to be double that by the end of this year, close to 10 planes. And we've seen very, very little impact of that as well. I mean, even from cancellation from customers or deferrals, it's been de minimis. So there's still close to over $300 billion worth of backlog on Boeing's balance sheet with these planes, and we still own PCP and are still very confident about the story 12 to 18 months out.
Switching gears slightly, it looks like the housing market is continuing to improve. Chris, how do you play that now? Because it seems to me that these home builders have really run up and could be a bit pricey here. Am I wrong?
No, I think you're right. When you look at Toll Brothers, Ryland Homes, Pulte Group, they've all had fantastic runs. So what we're actually doing now is starting to look at some of the suppliers, the building material companies, like a USG, for example, that does wallboard. It benefits from strong demand not only in residential construction, but also in commercial construction. It's also very solid in new construction as well as repair and remodel. You can also start to look at other companies like a Freeport-McMoRan. There's a significant amount of copper in each home, as well as in the auto market, which is also rebounding. So those are 2 examples of almost playing the ecosystem.
But
effect,
is the housing market enough to really boost Freeport? I mean, I thought you think copper, I think global economy play.
Yeah, well, that's spot on. And when we think about the data that we're seeing about the emerging markets, and particularly China in particular, a big consumer of copper, all of those have strengthened over the last several months. So there are several reasons to be bullish on Freeport.
All right, turning to the technology sector, Edward, sentiment seems to have turned against Apple. What's your take on the stock now? What do you do if you own it? What do you do if you don't own it?
Well, here at Chase Investment Counsel, our process is predicated really on earnings momentum and price momentum, which in Apple's case, the stock is clearly failing both those characteristics. This is a name that we still do have a minimum position size in. And I think, back to our previous discussion about how management teams are trying to monetize their balance sheets. I mean, this is clearly an example of a company that's going about and trying something new. It's true that they're seeing some production headwinds, and whether or not the iPhone 5S comes out in March or not. I mean, there's definitely some earnings pressures with Apple. And what they're trying to do is mobilize that $137 billion they have on the balance sheet with some sort of a dividend announcement, or more significant dividend increase, or even a share buyback.
Yeah, I mean, I'm glad you brought that up. I mean, Jason, what do you think of hedge fund manager David Einhorn's lawsuit against Apple? Seems like sort of a ploy to try to get Apple to unlock some of its cash and give it back to shareholders.
Yeah, again, it's all about that deployment. So I spoke with Einhorn in the past, spoke to him on this transaction as well, and he's looking at it and seeing, hey, this company has $128 billion, operating in depression-like mentality. Don't, get rid of my cash fortress. So, these hedge fund managers, when they don't get their point across, they take it to the airwaves. Is it a smart move? Perhaps. You saw Apple respond last night. There are some definitely interesting things to take from there. In the tech space, a couple of things we've been doing a lot of research into here at Benzinga is Tesla Motors. It's one that's been very controversial. We test drove it last week. Car is just unbelievable, a Tesla S. And it's like Google with doors and wheels on it. So if your listeners are looking for interesting technology plays that are maybe not as mainstream, that's one to take a look at.
Speaking of smartphones, Chris, what do you think of Research in Motion? Now it's rebranding itself as BlackBerry. What do you think of the Z10? Is it enough to bring this company back? Does RIM, or should I say BlackBerry, actually have a chance to be the #3 operating system for smartphones?
Yeah, it's really interesting. There is no strong third tier operating system, right? We've got Google's Android, we've got Apple's operating system. There's kind of a vacuum there being fought by, on the one side, BlackBerry, on the other hand, by Microsoft. But there are other ones out there. The announcement of BlackBerry's new phones, I think, gave it kind of a shot in the arm. But I think the real question is long term, when we've got smartphone prices coming down and we've got greater competition coming out of China. Huawei and ZTE, for the first time ever in the fourth quarter, were top 5 smartphone manufacturers by volume. So it's a real question as to whether or not RIM, you might like their products, but can they make money on these products when going up against these forces?
I guess time will tell, right?
Yes.
All right, well, continuing, I guess, still with the smartphone theme. Edward, you liked Qualcomm back in December. Do you still like Qualcomm at these levels?
Yeah, absolutely, Jennifer. This is our top holding in the large cap growth fund, and the theme of smartphones, the penetration, and what's going on with mobility. Qualcomm is a great play for that. It's a levered play because it sells sort of the chipsets into the OEMs, whether it's Samsung or Apple or any of the Chinese OEM that Chris talked about. And these guys are leading the pack in terms of technology. I mean, the Snapdragon chipset, which is in 500 devices globally and has reference designs in about 170 of them, continues to do very, very well. They're coming out with a 3rd generation chipset. It's in design right now, should be commercially available very soon. And this is a name that's going to grow earnings north of 20% this year and trading for less than that. So it's got a P to growth rate of less than 1, which is why we like it very much.
Do you have a target price for the stock?
The target price on this thing is about 20% higher from where it is today.
All right, well, where else are you finding opportunities now, Edward?
Well, going back to the other discussion, which is on U.S. housing, we're also finding peripherally opportunities that are levered to that space. So United Rentals, which is an equipment rental company, the biggest worldwide. In fact, it's got 3 times the size in terms of fleet and footprint of its nearest competitor. And this is a company that's got about 230,000 different items that you can pick from, in terms of loaders and lifts and backhoes. And this is a play on U.S. housing and commercial construction. They're getting good pricing of about mid-single digits. And they just recently finished an acquisition with RCS, which is going to allow them to better utilize their fleet. And this is going to be a good name for 2013. Again, this is a name growing earnings about 30% in 2013, about the same in 2014, trading at 11 times. So again, a great multiple expansion opportunity as well as very healthy earnings per share growth rate.
Jason, you mentioned you liked Tesla. Where else are you finding value now?
Yeah, I mean, we also been following the home builders too. Other places that we've been looking at are mortgages like Capstead. We see the reinsurance market coming back. We also been looking at, some of the ones that were more controversial, sort of like Groupon, zero debt on the balance sheet, throwing off free cash flow, has $1 billion in cash on the balance sheet. It's probably going to announce record sales for their Christmas holiday season. It's really rejiggered itself into being almost like an Amazon for really good deals, and what they are is a middleman that conducts these deals.
Wait a minute, did I just hear you equate Groupon to Amazon? Because I have to push back here. I mean, they have no competitive advantage, right? There's no moat there.
Yeah, but they do have something. So one thing that people forget about, when you go buy stuff, you probably use Amazon. That's your default thing because Amazon has your credit card. Amazon has your stuff stored away. I used to buy Daily Deal on Groupon. I rarely do that now, but they have my credit card info. So today I actually bought a Samsung Galaxy. Last week I bought something else for the office. I buy so much stuff there because you're getting a good deal. You don't need to shop around at different places. If it's on Groupon, it has the best price. That's what they've developed. Like it's like the Walmart. It's like the clearance house. If you want good prices, you're gonna go there. Amazon has a lot more variety. Groupon's going to have, when it's on Groupon, it's the best deal. You don't need to go anywhere else. Then they've also built in loyalty points. They're doing a lot of things that are bringing them on the right track. Zero Debt, Living Social is basically going out of business, it seems like. Now, Groupon, I do have an investment in, so, but wait till the next quarter's earnings, and I think you'll see some, very strong results.
All right,
and I know
well,
it's very controversial, so trust me, I don't say that.
all right, Chris, why don't you finish us off? Where are you finding opportunities right now?
Sure. Two areas that we're looking at are relating to some of the pain points I talked about earlier. Rising gas prices, rising food prices, weak disposable income. We're recommending clients get out of casual dining, Buffalo Wild Wings, Cheesecake Factory and the like, and circle back to McCormick's for that eat at home growth that we're looking at. And on the other side, the USDA has come out and said that corn, wheat inventories are really depleted after the drought last year. So we're taking a hard look at potash as well as some of the other fertilizer companies here.
Gentlemen, great discussion. Thanks so much to all of you for being with us. Hope to see you soon.
Thanks for having us.
And that's our show. Thanks so much for tuning in. As always, watch us online at www.youtube.com/Wall Street Report. Email us at wallstreetreportwithjen@gmail.com and follow me on Twitter @JenniferIsms.